Does checking your credit score lower it? If you said yes, you're not alone, but you're wrong. And that's not even the most expensive credit myth. Today, 9 things most people believe about credit that are flat out wrong.
Yeah, welcome to the Alpha English podcast. Go ahead and, get comfortable, grab a coffee,
Yeah.
because today we are really just sitting down, friend to friend, to have a super candid conversation about your money.
Exactly. And our whole mission today is just to help you stop losing cash, right? And stop losing credit points to what is honestly genuinely bad advice.
Right, and we have to emphasize right out of the gate here, if you currently believe any of the myths we're about to cover, please do not feel bad at all.
No, not at all.
Because the credit system is notoriously opaque. It honestly feels like it was designed to trip you up.
Oh, absolutely. I mean, mostly because you and I aren't the actual customers of the credit bureaus, right?
Right, the banks are.
Yeah, the banks are the customers.
Yeah.
So the rules aren't exactly printed on a neat little cheat sheet for our convenience. But, it's time to pull back the curtain and learn the truth.
I am so glad we're tackling this because the sheer amount of misinformation out there is just staggering.
It really is. So let's start with probably the single most common question people ask when they start trying to fix their finances.
Okay, hit me.
What is the magic number of credit cards I should have?
Ah, yes, the magic number.
Right. People are constantly looking for that one specific number that just magically unlocks a flawless credit score.
Which totally makes sense. Like, we're conditioned to look for a formula for everything. But to pull back that curtain right away, there is no official magic number.
Wait, really? None at all?
None. The scoring models, like FICO or VantageScore, they do not have some hard-coded threshold where they suddenly declare you a perfect borrower just because you have, exactly 4 cards.
Okay, that's wild. But there has to be an average,
Yeah.
right? Like, what is everyone else doing?
Well, yeah, if we look at the broader behavioral data, the national average right now is about 3.7 active credit cards per person.
3.7. Okay.
Yeah, and interestingly, that's actually down from 4.1 cards a decade ago.
Oh, wow. And, a huge driver of that drop is actually a massive generational shift.
Oh, for sure. Gen Z is totally changing the landscape.
Exactly. If you look at Gen Z, over 20% of them never use credit cards at all. Like, zero. They are entirely opting out of the traditional revolving credit system.
Right. They heavily prefer debit cards or just cash or those buy now, pay later services you see at online checkouts.
Yeah, like the ones where you pay in 4 installments or whatever.
Exactly. Meanwhile, older demographics are still utilizing multiple traditional credit cards, so that generational divide is heavily pulling the national average down.
Right. And while avoiding debt completely sounds incredibly responsible on the surface.
Yeah.
I mean, it sounds great the Gen Z trend might actually be accidentally hurting their financial profiles.
Yeah, especially when it comes time to buy a house or get a car loan. Because counterintuitively, having more than one credit card actually helps your score.
Which is so backwards to how we think about risk.
Totally. But it all comes down to the underlying math of your credit utilization ratio.
Okay, let's break that term down because utilization ratio is just industry jargon for a very simple concept, right? It's basically just how much of your available credit you're actually using at any given moment.
Right.
So let me give you a concrete scenario to show exactly how this mechanism works. Let's say you have just one credit card.
Okay, one card.
And the bank gave you a $1,000 credit limit. Now this month, you spend $500 on groceries and gas.
So you're using 500 out of 1,000.
Exactly. Which means you are at a 50% utilization rate. And in the credit world, 50% triggers massive alarm bells.
Oh, yeah, that's way too high.
Right. It signals to lenders that you are relying too heavily on borrowed money just to survive your month. And here's the trick. Let's say you decide to get a second credit card.
Okay.
And that second card also has a $1,000 limit. Now, your total available credit across all your accounts is $2,000.
Right, because you just add them together.
Yes. So if you take that exact same $500 of monthly spending and you just split it between the 2 cards, your overall utilization drops to 25%.
Which is so much better.
Exactly.
Yeah.
You did not change your spending habits by a single penny. You're still spending $500, but suddenly your credit score goes up because 25% looks much less risky to the algorithm.
And most people have no idea that you don't even need to use that second card to get the benefit.
Wait, really?
Yeah, you could put the entire $500 in the very first card, leave the second card sitting in a drawer with a zero balance, and your overall total utilization across your whole profile is still mathematically 25%.
Oh, that's fascinating. So just having it helps.
Exactly. Just having that available credit limit sitting there acts as a buffer.
Mhm.
It basically proves to the scoring models that other banks trust you with money, and more importantly, it proves you aren't desperate to spend it.
Okay, so a listener hearing that math might think, fantastic, I'm going to go apply for 30 credit cards today, get my total limit up to $1 million, and bring my utilization down to practically zero.
Oh my gosh, please do not do that.
Right. That sounds like a disaster.
It is. That is where the human element completely overrides the mathematical theory. Because having too many cards is just a logistical nightmare.
Yeah, keeping track of all that would be terrible.
Right. If managing 10 different due dates, separate banking apps, shifting balances, if all that causes you to make just one single human error and you miss a payment, the consequences are brutal.
How bad is a missed payment, really?
A single missed payment will drop your score 60 to 100 points almost instantly.
Oh, wow. That's a massive hit.
And that black mark stays anchored to your credit report for 7 years.
7 years for one mistake.
Yep. The penalty for a missed payment completely obliterates any minor point boost you might have gotten from having extra available credit.
Which means the real rule, like the only one that actually matters, is that the perfect number of credit cards is however many you can manage without ever missing a payment.
Exactly. Know yourself.
Right. For a complete beginner, that might just be one card. But for the average consumer, the sweet spot is usually 2 to 3 cards.
Yeah, that seems to be the most manageable.
It gives you that necessary utilization buffer we talked about without, turning your Sunday afternoon into a chaotic accounting job.
That sweet spot of 2 to 3 cards creates a really interesting psychological trap, though.
What do you mean?
Well, when people decide to simplify their financial lives, they often look at an old credit card they haven't used in like 5 years, and they think, I should be responsible and close this.
Oh, no. Do not close it.
Right.
The urge to clean house is one of the most common ways people unknowingly self-sabotage. Because when you call the bank and close an old card, you immediately wipe out all of that available credit from your profile.
Which spikes your utilization ratio on your remaining cards.
Instantly. And furthermore, eventually you lose the long history of having that account open. And that drags down your average account age, which is another major factor in your score.
So what should someone do instead? Just let it sit there empty in a drawer?
Actually, no. If it sits completely empty for too long, the bank will eventually close it for inactivity anyway.
Oh, true.
So you have to use what we call the zombie account strategy.
The zombie account strategy, I love that. How does it work?
You basically take that old card out of the drawer. You use it to pay for something tiny, like a $5 monthly streaming subscription, and you set the card to auto pay in full every single month from your checking account.
Oh, so it just runs in the background?
Exactly. You
Yeah.
automate it and forget it. You are keeping the account active, you're preserving your long credit history and your total credit limit without ever tempting yourself to actually carry a real balance.
I love that. Keeping a financial zombie alive just for the algorithm.
Literally just for the math.
It really highlights how doing what feels deeply responsible, like canceling an old piece of plastic, can actually hurt you because of how counterintuitive the scoring mechanism is.
Completely backwards.
And that bridges us perfectly into some of the more pervasive myths out there, because so much of the quote-unquote common sense advice about credit is actually completely backwards.
Yeah, let's run through them. And I want to start with what I consider the most toxic myth of all.
Okay, let's hear it.
The idea that you need to carry a balance from month to month to build your credit score.
Oh, man. This one drives me crazy.
Right.
It is staggering how many people still believe this. Let me be unequivocally clear. You do not ever need to pay a single cent of interest to build a great credit score.
Never.
Paying your statement balance in full every single month is exactly what the algorithms want to see.
So where did this myth even come from?
Well, the myth likely originated because credit card companies are businesses, right? They
Yeah.
make their massive profits off interest. So the cultural idea that carrying a balance is good was highly profitable for the industry to let circulate.
Oh, absolutely. It's a brilliant marketing for them.
But from a scoring perspective, carrying a balance only costs you your hard-earned money and interest charges, and it actively hurts your score by keeping your utilization higher than it needs to be. Pay it off entirely, every time.
Yes, please. Okay, let's move to a myth that stems from a very logical assumption. Myth. Your income affects your credit score.
Ah.
Like if someone gets a massive promotion and doubles their salary, they just assume their credit score is going to automatically jump up to reflect their new wealth.
I mean, it makes perfect intuitive sense, right? If you make more money, you have more cash flow, so naturally you're a safer bet for a loan.
Right, but the reality is much more compartmentalized.
Exactly, because the truth is that your income is completely invisible to credit scoring models. Companies like FICO do not know your salary. They do not have access to your W-2s, they can't see your bank account balances, and they don't know your net worth.
Wow. So they're just flying blind on how rich you are.
Pretty much. They are simply private data brokers measuring one very specific thing: your historical behavior managing debt.
Okay, so let's give a concrete scenario for this. You could have a public school teacher making, say, $45,000 a year,
Right.
and they pay their credit card in full every month. They never miss a payment on their modest auto loan, and they keep their utilization low. That teacher will easily have an elite 800-plus credit score.
Oh, without a doubt.
On flip side, you could have a CEO making $5 million a year, but they're highly leveraged, they max out multiple high-limit cards, and maybe they occasionally forget to pay a bill on time just because they're disorganized.
Yeah, that happens all the time.
That CEO will have a terrible credit score.
It's crucial to understand that the score is a measure of your reliability, not your wealth.
That's a great way to put it.
Now, to be fair, when you apply for something big, like a mortgage, the lender will ask for your income.
Right. They want those pay stubs.
Exactly. But they use that to calculate a totally separate metric called your debt-to-income ratio, just to ensure you can actually afford the monthly payments. Your paycheck does not factor into that 3-digit credit score itself.
That distinction explains so much of the confusion. All right. Here is another myth that creates endless frustration for people. The idea that you only have one credit score.
Oh yeah, this one is rough.
I remember years ago checking a free app on my phone, seeing an amazing number and feeling great.
We've all been there.
And then I went to a dealership to get a car loan. The finance manager pulled my credit, and the number they showed me was significantly lower. It honestly felt like I was being scammed.
It absolutely feels like a bait and switch when that happens, but the reality is you have dozens, if not hundreds, of different credit scores simultaneously. Yeah. It is not one unified grade handed down by the government. FICO, which stands for Fair Isaac Corporation, is a private analytics company, and they constantly update their algorithms. So there is FICO 8, FICO 9, FICO 10.
Like software updates.
Exactly.
Hmm.
Then you have a completely different competing company called VantageScore, which is usually the algorithm powering those free monitoring apps on your phone.
And to make it even more complex, lenders use industry-specific algorithms, right?
Yes, exactly.
Like the risk model used to determine if you qualify for a 30-year mortgage weighs certain past behaviors very differently than the algorithm used for a 5-year auto loan.
Right. A past missed rent payment might spook a mortgage lender significantly more than it would a car dealership.
And that is exactly why the free score on your phone rarely matches the paper the auto lender prints out. It's like having different teachers grade the exact same essay using entirely different rubrics.
That's a perfect analogy.
The underlying material, like your actual credit report, is the same, but the final grade depends on who's doing the math and what they care about most.
Exactly. The rubric changes. Speaking of rubrics, let's tackle one more major scoring myth that you see plastered all over financial blogs.
Oh, I bet I know which one.
Myth. The 30% credit utilization rule is your target. People are constantly advised, just make sure you keep your utilization right at 30%.
This one requires us to really understand how risk is measured, because aiming for 30% is terrible advice.
Really terrible.
30% is not a target. It is a danger ceiling. Think of your credit limit like the RPM gauge on your car's dashboard.
Okay, I like this.
30% isn't your smooth cruising speed. 30% is the red line where the engine starts whining and the algorithm starts thinking, uh-oh, this person is stretching their engine too hard. They might be running out of cash.
Right.
Sure, you haven't blown the engine yet, but you are not driving optimally. The algorithms start aggressively penalizing your score once you cross that 30% threshold, which is why it became known as a rule of thumb to just stay under it.
But if you look at the data of consumers who actually have the highest credit scores in the country, like the people sitting comfortably in the 800 club, they don't hover at 30%.
Not even close.
Their average utilization is consistently under 10%. So if you want an A+ on this metric, you need to aim for single digits.
I love the RPM analogy because it highlights that pushing the limit signals distress to the lender.
Absolutely.
Now, all this opacity about how these algorithms calculate risk leads us directly into our final major topic. And it's arguably the most damaging myth because it operates purely on fear.
Fear of the pull.
Yes, there is a deep-seated belief that merely looking at your own credit report will cause your score to drop.
Yeah.
People are terrified to even check.
And that fear stems from a fundamental misunderstanding of the two different types of credit inquiries.
Let's break down the mechanics of a soft pull versus a hard pull, because avoiding your credit report actively prevents you from protecting yourself from identity theft.
It really does. So let's start with the harmless one. A soft inquiry or a soft pull has absolutely zero impact on your credit score.
None at all.
None. You can check it 1,000 times a day and your score will not budge.
Okay, so what counts as a soft pull?
When you check your score on an app, when you look at it through your online banking portal, or when a credit card company does a background sweep to send you a pre-approval letter in the mail, those are all soft pulls.
Because you aren't actually asking for money.
Exactly. They don't hurt you because you aren't actually asking to borrow, you're just reviewing the data. Sadly, over 20% of consumers still don't know this.
20%. That's a lot of people.
Right. Because they are afraid of losing points, they refuse to monitor their reports, which means they completely miss the early warning signs of fraudulent accounts being opened in their name until it's sent to collections.
Which is a nightmare to unwind.
Yeah.
Okay, so if soft pulls are completely harmless and just informational, what actually triggers a penalty?
That brings us to the hard inquiry. This happens when you explicitly apply for new active credit, like submitting an application for a mortgage, an auto loan, or a new credit card.
So when you officially hit submit on an application.
Yes. The lender pulls your full file to make a lending decision. Now, a hard inquiry does lower your score, but we need to put the actual damage into perspective here.
Right, because people panic about this.
A hard pull typically only drops your score by about 5 points.
5 points, that's it.
That's it. It is a tiny, temporary ding. The mechanism here is simple. Actively seeking new debt makes you statistically just a tiny bit riskier in the short term. However, the impact of that 5-point drop fades after about 12 months, even though the record of the inquiry itself remains visible on your report for 2 years.
Okay, but what if I need to shop around? Like, say I'm buying a house. I don't want to just take the first mortgage rate I'm offered.
Right. And here's the kicker.
Yeah.
People get so paranoid about those 5-point drops that they refuse to shop around for the best interest rates on massive life-changing loans.
Which is crazy.
They will take the very first mortgage rate a bank offers them because they are terrified. A second hard pull will ruin their credit. And that fear ends up costing them tens of thousands of dollars in extra interest over a 30-year loan.
Oh, easily.
The credit bureaus actually know this, and they want their models to be accurate reflections of risk. Penalizing a smart consumer for comparing rates makes the model less accurate. So they built an exception into the algorithm for rate shopping.
Okay, how does that exception actually work in practice? Like, what's the window?
If you are shopping for a big installment loan, specifically a mortgage, an auto loan, or a student loan, you are given a 14-day window.
14 days.
Yeah. You can go out and apply with 10 different banks or mortgage brokers within those 2 weeks to find the absolute lowest interest rate. The scoring model is smart enough to recognize the behavior. It knows you aren't trying to buy 10 houses, you are just rate shopping for one.
Right.
So it takes all 10 of those hard inquiries, groups them together, and counts them as just one single hard pull on your score.
That is massive for anyone navigating the housing market.
Yeah.
But I have to push back here,
Yeah.
because people frequently try to game the system, right?
Oh, always.
Does that 14-day shopping trick work for credit cards? What if a listener decides to hunt for sign-up bonuses and applies for 5 different reward cards this weekend? Do those get grouped into one hit?
I cannot emphasize this strongly enough. No.
No, we can't.
That exception is strictly for installment loans, where you receive a fixed amount of money for a specific purchase. Credit cards are revolving credit. Every single card application is an entirely separate hard hit.
Ouch.
If you apply for 5 credit cards in one weekend, you are going to take 5 separate hits to your score. And more importantly, lenders are going to see a flurry of requests for revolving credit, which makes you look incredibly desperate for cash. It is a massive red flag that will likely lead to automatic denials.
Yeah, that is a critical distinction to keep in mind. Just don't do it. All right, we have covered a tremendous amount of ground today regarding how this opaque system actually functions.
We really have.
Let's wrap up our conversation by firing off a few more common myths in a rapid-fire lightning round. I will make a claim, and you tell me if it's a myth or a fact in just one sentence. Ready?
Let's do it.
Claim number 1. Getting married merges your credit scores into one joint marital score.
Myth. Marital status has zero impact on the algorithms. Your credit reports and your scores remain strictly individual.
Claim number 2. Paying off an old collection debt makes it immediately disappear from your credit report.
Myth. A negative mark can stay on your report for up to 7 years even after it's paid, though a paid collection looks significantly better to future lenders than an unpaid one.
Last one. Claim number 3. Closing your oldest credit card hurts your score.
Fact. Closing it instantly reduces your total available credit, which hurts your utilization ratio, and it eventually kills your average account age.
Excellent. As we wrap up, it's worth noting that the rules we've discussed today are just the current state of play. The game is already evolving. Lenders are starting to experiment with alternative data, using AI to scan your history of paying rent, your utility bills, and even your cash flow patterns in your checking account to determine your risk level.
Yep.
In a few years, the 3-digit score might just be one small piece of a much larger algorithmic puzzle.
It's true, the system never stops shifting. But until then, the foundational rules of paying on time, keeping balances low, and ignoring the bad advice remain your best defense. Tonight, go ahead and log into your app, check your credit score. It won't cost you a single point. But continuing to believe the wrong advice, that might just cost you a fortune.
That's it for today. If any of these myths surprised you, share this episode with someone who probably still believes them. This is Alpha English Podcast. See you next time.